and focus more on manufacturing and the likes.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Vineeta Sharma of Narnolia Financial Advisor, Senthil Manikandan of Newberry Capital, and independent investment advisor Vivek Mavani join me on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss stocks like Raymond, which is up almost close to 20% post their numbers that came out on Thursday. ITC, we'll discuss ITC, how the financials has panned out. Some of their sectors, some of their verticals did well, some of them didn't. We'll discuss that. Equitas and Ujjivan had a big fall on Friday post the RBI indicating that they have to list their small finance, their banking operations as soon as possible. And Kajaria Ceramics, after a few quarters of disappointment, finally came out with a good set of numbers. We'll analyze what's the way ahead for Kajaria Ceramics. But we'll first start with Raymond. That's the first stock. Came out with a number which was very, very strong. Did manage to rally close to almost 10% on Friday. It's up another 8% on strong volumes today. But remember, Raymond has already corrected it did manage to correct some 45% from the top before this rally has again started. What's the view on Raymond going ahead, and what do you make of the numbers? We'll ask our guest. I'll start with you, Vivek. Raymond, the numbers and what's the way ahead for Raymond?
Well, couple of things as far as Raymond is concerned. So, and I'm not specifically referring to the quarter just gone by. The quarter just gone by, yes, the growth in profits was fairly impressive at almost 50%, which is very rare for Raymond to report these kind of numbers. But on a larger issue, Raymond, in terms of their brand franchise, distribution network, product profile, I mean, it's got a terrific business, except that the management doesn't give much confidence over the years. Whether it's corporate governance issues, whether it's transparency issues, or bare bones, if I may say, just the numbers in terms of suboptimal profitability and return on capital and strained cash flows. That really doesn't give confidence from the kind of brand equity and the business moat that one would be talking about. So, from that point of view, I would leave Raymond aside. I'm okay to leave that opportunity simply from the management quality point of view, which leaves a lot to be desired. That's number one. Number two, if we look at the margin profile of Raymond, whether it is the core textiles business, the branded garments business, which is the core Raymond besides Park Avenue, Color Plus and accessories business. And if I were to look at similar companies, so say for example in textiles business, if I were to compare it to a CRM, I mean CRM earns say 15, 16 or maybe good times they have earned even 18% return on capital with a steady state about 12 to 14% EBITDA margins. Raymond, which has got much better product profile than CRM, does not even earn that much. I mean on textiles they make about 10%. In branded garments business, I mean it's probably one of the largest besides Arvind, with almost 2,500 crores of annualized top line. They barely make 5% EBITDA margins. And if I were to look at a Keval Kiran, which is about a 500 crore business, makes 28% EBITDA margins. Indian Terrain makes about 12 to 14% range of margins with about 16-17% return on capital, return on equity. Keval Kiran, by the way, makes about 30% return on capital, return on equity. So on a like-to-like basis, if I were to look at each business and compare it to a comparable which is either much smaller or probably inferior in product profile and business profile, then Raymond leaves a lot to be desired. So from that point of view, in spite of these numbers, even if I were to look at valuations, well, they still leave nothing on the table. The management doesn't give me the confidence, the valuation doesn't give me the confidence. So I'm happy to leave that opportunity.
Okay, that's the view that's coming in. What about you, Vineeta? First of all, your view on the numbers, and do you agree that Raymond is lagging behind its peers in all aspects?
Yeah, overall, see, considering the space that it is in, the branded segment and textile overall, you know, we are positive on the brand format that is going on in India, and that space we are comfortable, and we like Raymond because of its brand positioning. The kind of yeah, definitely I agree with the management comfort doesn't come in, but lately we have seen that management is acting on the right direction. The kind of stores format, they have changed the strategy. They have gone into more of franchise stores. Also, they have, you know, they are coming. If you look at the top line is pretty stable. It is going ahead just in the way we want it to be. Just the it's not translating into the EBITDA and post EBITDA. EBITDA also this time it has improved quite a bit. It is around 11.8% on the quarter basis, and post EBITDA. So there is what the allocation of the cost is not coming proper. So it's not translating into the profits. So management in this recent con call, they have you know, they have given little bit of confidence. They have given guidance which earlier was not with which we were not comfortable. So I think it's considering the whole space, the branded segment, I think we are comfortable with Raymond. It also has a land bank 125 crores, which is I think not factored into the price valuations.
Okay, that's the view that's coming in on Raymond. So we have a different view that's coming in. And Senthil, what side would you be on? What's your view on Raymond?
So first, if you look at the Q2 numbers, like you said, both on the branded textiles and the branded apparels, the revenue growth has been around 15%. And one more item is the garmenting business also has turned up year over year. Like look at the operating profit, somewhat doubled in the year over year. So operationally, the textile segment, apparel segment is doing well. But you can't compare Raymond with other branded textile players or apparel players like ABFRL, because Raymond also has the tools and auto component business, and now they are also getting into the real estate development business. So I think like Vivek and Vineeta mentioned, I think it's going to be a diversified conglomerate kind of company. But after the results, you have seen the move up in the stock price, basically because it has to do with the valuations. Because if you compare the other players in the branded textile segment, they are trading at a EV to EBITDA of around 20 times. But here it's trading at a EV to EBITDA of just 10 times. So I think valuations are just catching up with the others, even though we believe that there should at least be a discount, because it's not a focused player getting into the growth prospects, which is going to come in because of discretionary spending is going to increase. So there should be a valuation discount with the others. So we will wait and watch for the operating level improvement in the apparel business. So now they are doing a EBITDA margin of around 3 to 4%. And the management has been guided for a asset light expansion in this category. So they are opening mini TRS stores. Currently they have around 140 kind of stores. So we have to wait and watch for how they are operatingly improving this apparel development and take a call further. So we remain neutral on those two.
Okay, so that's the view that's coming in on Raymond at this point of time. Before I move on, Vivek, very quickly, you spoke about issues with the management. Now it's a professional management that's running, and still do you have a little bit of issues? Very quickly, with Singhanias are not running the show, but do you still have issues with that?
Well, with Singhanias or not, whether they are in the driving seat or whether it's professionals, at the end of the day, a business has to earn, a business has to be profitable on a sustainable basis, has to earn return on capital and return on equity higher than cost of funds. So I'll just continue the argument that Senthil mentioned, that from a valuation point of view, EV by EBITDA, it is cheaper. Well, it's cheaper, but so is the numbers so much more inferior, both in terms of lower margins, and we have much lower return on capital, return on equity. So even if professionals are running it, I would probably desire to have margins much higher, in line with what the business and the product profile, the brand profile it is, number one. And if that cannot happen, it certainly deserves to trade at a discount to other textile and branded garment plays.
Okay, so that's the view that's coming in. I think you got a 360. The audience actually got a 360-degree view on what they should do with Raymond going ahead. The other counter that came out with numbers, inline set of numbers, was ITC. Now, the cigarette volume was something that came in much higher this time around, close to 7 to 8%. Some of their, other FMCG did well. Their paper business did extremely well, and you can see the rally that's come in on the other paper stocks also. But on an overall basis, how would you rate the numbers, and what's the view ahead? Vineeta, ITC, what did you make of the numbers, and what's your house view on ITC?
So we are positive on ITC, and we have a price target of around 338.
Okay.
The sales have grown around 7%, PAT has grown 10% plus. So, and if you look at the overall business, the cigarette business, I think the distribution thing is playing on well. If you look at the cigarette business, they have moderated, in fact, because of some stocks loss in Kerala, as well as I think that should improve from here on. The tax, considering the poor conditions and industry environment ITC is working in, still the volumes have been pretty good on the cigarette business. The other FMCG, which contributes little to the profits, but on a top line it contributes around 21-25%. So that is then EBITDA has grown up by 77%, and that is where there are new product launches as well as operation of scale, and the cost has been higher. Despite that, the EBITDA has grown by 77%. There were some 2-3 new products that were launched back. So considering the gestation period for them to pick up, still we saw good amount of profit growth in that segment. Then comes your paper. Paper has done pretty well. There was one rebuilding of capacity, and which added to some volume in the ITC, and also there has been, so overall operational efficiencies has played into ITC. The hotel business, which contributes only 3% to the top line, if you look at it, Hyderabad ITC Kohinoor, that is doing receiving pretty good response. Also, they have bought in, I think in Goa, they have bought Park Hyatt. So they are going aggressive in the hotel segment also. The food packaging business, they have come up with 10 new products there, and in the frozen segment, and that is not rolled out in the countrywide scale, but 2-3 places they have been rolled up. So overall, if you look at several pockets of ITC, I think there has been a broad-based growth in ITC.
Okay.
And recent problem what ITC was feeling that was that there was no asset turnover was not improving, and because of which the return ratios were pretty at par with what it has not grown. It wasn't sub 25%, but it was not growing. So we are expecting return ratios to improve from here on.
Okay, what about you, Senthil? ITC, what did you make of the numbers, and what's the view ahead?
So on the Q2, sales volume growth for the cigarette business is estimated to be around 5 to 6%, since the company don't disclose the volume figures. So it's on the positive range, because after degrowth in the previous 4-5 quarters, I think 5 to 6% volume growth is on the positive range. And in the FMCG side, there's been a little let down. They posted a revenue growth of just 12% versus the expectation on the range of 15% kind of growth. And still, like Vineeta mentioned, FMCG has been in the investment phase. So if you look at the consolidated level, cigarette business revenue contribution is around 40%, but on the operating level, cigarette business is contributing 85% of the profits. So I think the major divergence of valuation between the ITC and for the likes of HUL has been the GST, the increase in GST rates overhang on the cigarette business, with cigarette contributing 80% of the profits. So whenever for example, in the recent Kerala floods, there has been a lot of noises about bringing up a disaster relief cess for these demerit goods. So as long as these kind of tax overhang on the business exists, then the valuation differential within the other players would continue. So we could be watching out for the FMCG business, because now it's in the investment phase, but they have 4-5 large brands they have built in the last 6-7 years, likes of Ashirvad or EP in the noodles category. So we'll be watching out for this FMCG category. So I think the valuation re-rating would happen only when the FMCG gets a good margin.
Okay, what about you, Vivek, ITC?
Well, I've been positive on ITC for a while now, and you would recollect on several occasions I have spoken positive about ITC in the last 1 year on this very show. So basically, I'm not getting again into numbers as to what cigarette and non-cigarette volume growth did. Two things that I would what makes me positive. One is in terms of sustainability and consistency of growth. Very few companies can match that with ITC. After difficult 2017 and 2018 in terms of both on the tax side, adjustments, etc. The cigarette business is back to clocking high or mid-single digit volume growth, which is likely to continue, giving it a probably about double-digit volume growth in cigarettes. The non-cigarette FMCG is now on a sustainable trend of improving margins on back of new product launches, on back of scale benefits, etc. Third thing, ITC always traded at a discount, something which Senthil just mentioned, compared to the other large FMCG companies, whether it's HUL or Nestle, for two reasons. One was a diversified conglomerate which also has hotels and paper and agri trading business. So that's number one. So the conglomerate discount. Number two, it had return on capital and return on equity lower than most other FMCG companies, and hence even the valuation multiple discount to other FMCG companies, namely HUL and Nestle, because that's what you can compare in terms of size. You can't compare it to lot other FMCG companies simply because the size difference is a bit too large, ITC versus somebody else. Now what we are seeing is sustained improvement in the non-cigarette FMCG business, also leading to improvement in return on capital on the individual businesses as well as on the consolidated balance sheet. 2019 and onwards, or maybe even in 2020 onwards, it is probably on a sustainable trend of clocking 35 to 40% range of return on capital, return on equity, which is quite in line with what other FMCG companies do, and hence the valuation discount that ITC had for over the years, I think that discount should narrow, which is what I'm referring to as a terrific opportunity in ITC, because on the earnings side, the ability of ITC to deliver about 15% earnings growth on a sustainable basis, there's no doubt on that. Valuation discount compared to other FMCG will give it an additional trigger. Add to which, in a volatile market, ITC also is a preferred bet because it's an extremely low beta stock, extremely low beta stock compared to most other nifty stocks. So it also gives you relatively capital protection. So I continue to remain positive on ITC, with a disclaimer being that I have a personal as well as interest on behalf of clients in ITC.
Okay, so that's the view that's coming in on ITC. It's a positive view. Before we move on, pull up Adani Power, pull up Tata Power. Supreme Court has asked CERC to decide on amending the power purchase agreement in the next 8 weeks. Both of them have rallied significantly. Tata Power is up, Adani Power is up 10%, Tata Power is up close to 20%, 17%. So there is positive news that's coming from what the Supreme Court has said. But we'll move on with hot money. Two stocks which were in focus on Friday, Equitas and Ujjivan, both of them cracked anywhere between 20 to 25% post the RBI telling them that, you know, their banks should be listed. Which will give them a holding company discount, and that's what the market is fearing on them. So what's the way ahead on Equitas and Ujjivan? Are valuations now ripe? Should you enter these counters, or is there more pain point? I'll start with you, Senthil. If these two stocks, what should one do? The news is out now and the counters have corrected. Now you're getting these counters 30% cheaper. What should one do?
So with the RBI circular, I think the investment thesis completely changes. So now these two listed entities will become a holding company whenever their small finance banks get listed. So we have seen in the market currently the holding companies warranted discounts of nearly from 30 to 70% kind of discount to their investments. So same way will apply to these two entities also. I think the market has factored in majority of this in last Friday with a steep correction in both these stocks. Coming on to the Ujjivan and Equitas small finance fundamentals, I think both these entities, since getting the license, they have been in the investment phase. They have been aggressively converting their branches into a full-fledged banking franchisee. So on the product level, if you look at, if you refer Equitas, because they have been able to garner more amount of deposits, and especially in their CASA deposits now factoring around 35%. On the liabilities side also, I think they have been able to, on the asset side also, they have been able to diversify their book. Now with microfinance around 30%, other 30% comes from their vehicles and their SME business. If you compare it with Ujjivan, I think Ujjivan has been majorly in the microfinance focused entity. So for Ujjivan to diversify in this environment, it could be difficult. It will take a toll on their growth prospects also. Okay. So we'll be looking for Equitas Small Finance Bank once it gets listed, because I think we have to look for the valuations also, because currently the return multiples are not quite favorable compared to the other existing stocks. So we have to wait for the entities to list and then take a call.
Okay, what about you, Vivek? The news is out. What should one do now?
Well, firstly, I'm going to address it for Ujjivan and Equitas as well as for the NBFC space. Also, why suddenly a knee-jerk reaction sort of baffles me. The most important thing is, in the last 2 years, NBFC valuations had run up far too much for comfort that would justify their growth rates, and I mean, market participants seem to assume that a 30% growth was their birthright, with less than 1% NPAs which would go on to perpetuity. Now, obviously that scenario would not have lasted very long, and overall NBFCs have been in corrective mode simply because the cycle has turned, number one. So what happened in Ujjivan just happens to be a news item which came up on Thursday, thanks to what RBI's diktat of to play by the rule book. Now, in 2016, when both Ujjivan and Equitas got their small finance bank license, this was a precondition in terms of listing the bank in 3 years. So it is not something which came out of the blues. Either market participants ignored that fact, which RBI reminded everybody, including the management, to just wake up and start preparing for a listing of the small finance bank, or the managements of both were also oblivious or and not guiding the market participants correctly in terms of their game plan, or in terms of their strategy going forward in terms of listing the SFB, that's a small finance bank. Either which way, the correction would have happened. I mean, this Thursday, Thursday evening's announcement from RBI, or the circular notification, whatever you call it, the Friday was a knee-jerk reaction which anyway would have happened. If not on one day, it would have happened over a period of time. Now, even now, if we look at the valuations, they are both at about maybe 1.3 to 1.5 times price to book, and since they are still in the investment phase, return on equity is still not up to the mark. The third thing that I would like to add is NBFCs are anyway falling out of favor. There's a steep correction or compression in valuation multiples. So it's like now catching a falling knife, and I'm not really a fan of catching falling knives. I mean, there's going to be enough time to bargain hunt in Equitas, Ujjivan, or any other NBFC over the next few quarters or next few months. It's best to just ignore it at this point of time. Okay,
Vineeta, what about you? What did you all make of this announcement?
So I'll add a little different perspective to it, Darshan, in the sense that once these banks get listed, they'll have to, at least the promoter will have at least 75% in the so they'll have to go in for an equity dilution of around 25%. Okay. So they will already, the CAR is around 29% for Equitas, or similar level for Ujjivan. So they'll have enough liquidity. Now, where to park this money that they will get? So already they are going around 30%. If they get in extra 25% as equity, they'll obviously have to park in that money somewhere. So either into the growth, getting more advances, or getting into putting it into some investment. Now, if they put it into investments, obviously the return ratio would be a little less than what you earn from the advances, right? So that will affect the return on asset of the company as such by a huge margin. because what return on asset right now we are seeing after equity dilution for nearly 2 years. I think this will be a little overhang and the return on asset will be hampered. Now, if they go in for growth, obviously it's difficult for them to grow at a 70-75% growth because if they had that much money, they'll have to grow in that way. So they'll have to take up risk in the book, which management right now, whatever, both the management, I think we are pretty comfortable with both the management, the kind of, the way they sail through demonetization. I don't think they'll add on more risk into their portfolio. So, considering some 1 to 2 year period in the near term, definitely return on asset will be under a lot of pressure. And but if somebody who is seeing a 3-4 year investment point of view, I think they are at a pretty nice place to buy in.
Okay, so that's the view that's coming in. We're running out of time, so for the last talk, we'll just have to rush through with the initial comments, and that is the Kajaria Ceramics. The numbers came out. The stock did manage to rally. It's flat in today's trade. We'll go very fast. Just initial comments. What did you make of Kajaria?
See, Kajaria has been running short of volumes for the past 2 years, 17 and even 18. So it has come up with a good volume growth. Management guided for 12 to 15. It's come up, but I think 18% or so volume growth was there. So volume growth is giving some operational efficiency. The margins have been pretty stable. The margin fall has been arrested. Gross margin is also getting stable, EBITDA margin also getting stable, and the organized GST ke karan the organized play will again get into play. So I think they are at pretty low valuation, but we should see one more quarter for how the volume growth pans out.
Senthil, initial comments Kajaria.
So Kajaria remains our favored pick in the tiles category because of their margin profile and returns. Their return profile they have shown in the last 7-8 years. Because 70% of the sales comes from the retail business. For others, it's around 50-50 between retail and institutionals. But one key risk is that we have to watch out for how the real estate as a sector perform here now, because all these demand comes from majorly from the 30% of sales comes from the institutional categories. I think that could be the key risk, but after the stock has corrected nearly 40% from its peak, I think currently it's trading at around 20 times 1 year forward earnings, and with your ROE, ROC of upwards of 25% and your balance sheet, there are net cash balance sheet. So I think it remains one of the preferred picks, but one has to be cautious considering the real estate sector, which is how it is going to pan out.
Okay, and Vivek, quickly, your initial view on Kajaria.
My sense is even after a 50% price correction in the last few months from its highs, I think the correction has been rightly so and well deserved. And my sense is it's unlikely to really perform for what it had done in the previous 5-6 years for two reasons. In spite of being the largest tiles player, it has practically very little pricing power, number one, in spite of the 70% retail, etc. Number two, what enabled it to have perform very well was also the low crude oil price scenario, which resulted in low gas prices, which also has turned in the last 1 year. So there is pressure on cost. Third, the whole argument about unorganized moving to organized, unbranded to branded. I mean, the largest ceramic tiles manufacturing cluster is in Gujarat, the Morbi area. So Morbi, which always has enjoyed a cost advantage over the larger players like Kajaria, actually they call in the shots as far as the trade is concerned, the trade and distribution, which affects Kajaria both on the pricing as well as on extended working capital, because now Kajaria is forced to offer higher trade credit, etc. Fourth, falling return on capital and return on equity, which is likely to happen over the next couple of years. Fifth, diversification into plywood trading of a business, which again they believe that they can replicate the tiles, but I think they really can't get that cost structure right. That's my sense. So over the next few years, what we will see is Kajaria having pressure on margins, pressure on growth, pressure on return on capital, return on equity. So the valuations, I think, will take a beating in the long run.
Okay, so that's the view that's coming in on Kajaria. We have again had contrarian views that are coming in on Kajaria, but this time we are really run out of time on the show. It's a wrap on today's Hot Money. Vivek, Senthil and Vineeta, thank you so much for coming in the studio. Ask BQ comes up next. Stay tuned to Bloomberg.